I also want to thank the conference organizers, but not for the usual thing. I want to thank them because for I think the first time ever, Jonathan Burke isn't the chair of my my session, and I'm gonna get my fair share of time this time.
Jonathan emailed me.
Here's the research agenda of Robert and Hanno and a bunch of their co-authors and some other people. They want us to think about foreign exchange like we think of equities. They want us to ask questions like, how much common variation is there in exchange rates? What's the best way to characterize this common variation? How do individual currencies load on this common variation? Is the common variation priced? Does cross-sectional variation in the loadings line up with average returns on the currencies? Which economic models generate this sort of factor structure? Okay, so that's the broad research agenda. What this paper is about, it's about the first two. Okay, and what they want you to take away from this is that there's this economic geography in terms of the common variation in exchange rates and the loadings on that common variation. Okay, so here's a picture that's where I'm going to try and give you my take on what's going on. As I was reviewing my stuff this morning, it occurred to me that these central countries look like a snowman. But that was purely accidental. This is not me trying to be cute. So we've got this economic geography. Distance plays a role, but there's a bunch of other variables, as Robert was pretty clear upon. Okay, so you've got peripheral countries like Brazil and Chile, and then central countries like the US and Japan. Okay, what you realize, kind of unlike equities, when you start thinking about factor structures and exchange rates, is that the choice of the numeraire becomes important, becomes kind of a mess in a way. And so Brazil here is a red dot. Okay, so I'm going to make Brazil the numeraire. And so here's what these guys do. Common variation in exchange rates. We're going to take all the bilateral pairs against Brazil, and at each point in time, we're going to take the depreciation rate and then average cross-sectionally, and that average is our measure of common variation. Okay, we do that for each point in time, and we've got this time series of the common variation in exchange rates with Brazil as the numeraire. Okay, and in a nutshell, what the results are is now what we're going to do, once we've got this measure of common variation, is we're going to run a regression of each of the bilateral exchange rates on this measure of common variation. And the R squared from that regression is going to be the common variation in that bilateral exchange rate. And then the slope coefficient is going to be the loading. Okay, so what in a nutshell, what the results are is there's a lot of common variation when you make Brazil the numeraire. And that's associated with Brazil being a peripheral country. And then the loadings have this geography as well. The loadings for Japan and the US are large relative to Chile. Okay, so that's at least in terms of the empirical work, what the essence of this paper is. I'm not going to talk about the SDF model stuff. Not that it's not interesting, it's just I only have 15 minutes. So my first point is kind of the extent to which this is surprising, that we get this geography and the common variation in the loadings. So here's a caricature related to inflation, a caricature to express what I mean. Right? We know that Brazil, in addition to being peripheral, is a high inflation country, with a long history of volatile and high inflation. So when Brazil devalues, most of the world appreciates against Brazil, in particular the centrally located countries. So you just know that in the bilateral currencies, there's going to be a lot of common variation in there because we have Brazil as the numeraire. And you also know that the loadings are going to follow this geography, in that the loadings for US and Japan are going to be bigger than Chile, because Chile is also a country with a long history of inflation. And it's not so much the case that when Brazil devalues against the whole world, Chile appreciates. So I guess my point is, my inflation caricature is by virtue of here having Brazil as the numeraire, are we kind of relabeling an inflation effect that I guess we kind of knew about, or relabeling that a gravity effect. Now I'm going to change that red dot for Brazil to the US just to make this point a little bit more, just to articulate this a little bit more. Think of the US as the numeraire. Okay, the U.S. Has a low, stable inflation history, and so does many of its neighbors that are close in this geography. And it's not the case that when the U.S. Devalues against Japan, it devalues against everything else. Sometimes when Japan goes up, Europe goes down, and so on. So you know that the common variation in the bilateral pairs with the U.S. as the numeraire is going to be lower, and the same is going to be true of the loadings. So what's my point here? It's not that the results are known nor obvious, okay? My inflation story is a caricature to try and get across the way I'm trying to think about this. The Lustig-Richmond story is much richer, involving geographic, legal, cultural variables, etc. They find gravity effects among the developed world, okay? Whereas my story is kind of developed versus developing. Nevertheless, the cross-country growth institutions literature tells us that these variables, including inflation, are highly intertwined. And this inflation caricature probably contains a grain of truth. The paper's extensive results about currency pegs kind of buttress my point here. And I think responding to this is going to be a challenge for this paper. So that's kind of point one. So the numeraire matters a lot for measuring common variation and what currency risk is associated with that. So it got me thinking about, is this the right way to deal with this? Just make a huge table where we've got all the numeraires there. Is there some way to make this lower dimensional? Is it the best way to show all the numeraires? Returning to the equity analog for a second, I guess we could kind of do the same thing. We could take all the stock prices out there, and instead of having them in units of dollars, we could have them in units of shares in the Bitcoin ETF. And of course, we're going to get tons of common variation, because when the Bitcoin ETF crashes, all the shares in there go up. The natural response there is, don't do that, right? It'd be a crazy thing to do, mostly because hopefully nobody's just holding the Bitcoin ETF, and nobody cares about that numeraire in and of itself. That's not true of Brazil and all these other countries. So you can't just say, don't do that. And so this numeraire issue here is kind of inescapable. And I think the paper does deal with it in a sensible way. It does ask me to believe, is there some kind of numeraire-free alternative? Vertelgen's got this paper that's in this research agenda that I was talking about, where he takes their dollar base factor and extracts a global component of that, which is kind of more numeraire free. And he argues that you can take this thing and sort of do currency pricing in any numeraire that you like, and you get the same results. So maybe it would be interesting to look at Vertelgen's global piece of the USD factor and look at the geography in there, and this would be a little less numeraire free, or a little less numeraire dependent. Okay, this then got me thinking about what's the right measure of common variation. Now I'm going to talk about the weighting scheme. Their base factors are all equally weighted. We're taking an equally weighted average across all these exchange rates. Returning to the equity analog for a second, I asked myself, what do we do like in a CAP-M world? Well, we regress each stock on the return of the market portfolio. And the R squared in that regression is our measure of common variation in that stock. And then there's the loading. The market portfolio is a value-weighted average. Why? Well, it's because this is the portfolio that the representative agent has to hold in equilibrium. Put differently, this portfolio measures marginal utility growth for this agent, and a stock's risk is how it loads on marginal utility growth. Okay? So I'm not saying there's anything wrong with measuring common variation as an equally weighted average. I guess if I was saying that would be kind of a criticism of a lot of empirical finance. But for equilibrium models, I think this equal weighting is less relevant than, then this equal weighting is less relevant than value weighting. And I'm going to try and argue that that's maybe even more the case for macroeconomic questions in international. What would you do, sort of given this equity analog, for exchange rates? Well, how about this? Let's not take an equally weighted average of all the bilateral exchange rates. Let's take how much time, Ken? Let's take a value-weighted average where the value weights are the global market cap weights. Why do that? I guess I'd have in mind a complete markets model, a model with a lot of international risk sharing, where the home investor holds the global market portfolio. This paper is about common variation in currencies. Why am I putting equity weights on the currencies to define what common variation is? Well, same thing, because the home investor's marginal utility exposure to each currency will be tightly aligned with these equity weights. Okay? For example, if US equity ownership in Brazil is 0, then the common variation in exchange rates that's relevant for the US investor doesn't depend on the Brazilian real. I thought about getting data for that, I couldn't find it, so here's something similar. Trade weighting, okay, not global market cap weighting. So common variation is a trade-weighted average. Why this? You might think of an incomplete markets model with limited international risk sharing, where movements in traded goods relative prices can affect marginal utility because people aren't able to trade state contingent contracts. This is essentially a story about real exchange rates, and I'll get to that in a second. But I'm going to show you stuff about nominal exchange rates, which we often do in this area because real and nominal exchange rates look pretty similar. Okay, again, the point is that variation in the exchange rates of non-trading partners are not relevant for common variation in exchange rates that affects marginal utility growth if we have this incomplete market setting. So what I got is it's kind of a very small fragment of what they've done empirically, but I got trade-weighted exchange rate, U.S. dollar base only, okay, and run this regression of, I don't have all these other gravity variables, just distance, okay? And so this is the loadings, and here are the R-squareds relative to the trade-weighted exchange rate, which is now what I'm going to call common variation. And what you see is you get the opposite of what they're finding. Okay, you get their gravity effect has this relationship be positive. Okay, more distant countries have higher loadings. And when you look at the trade-weighted definition of common variation, you get a negative relationship. So that's interesting. Why is that? Why is what they're calling gravity effects, why do those go away? Well, it's because there's gravity effects in the trade weights. In a way, the paper's point is its own undoing if you buy that the right measure of common variation is this trade-weighted average. Okay, and what does that mean? Well, the gravity literature tells us that we're going to put less weight on the distant countries. This paper relies upon putting equal weight on those distant countries, and if it's those distant countries that's driving everything, think of my Brazil example, then their effects are going to be muted. Okay, so my point. My very rough calculations, I'm feeling a little time stressed, so I should mention that my R-squared calculations here are, what they've done is they've taken the average of all these things, and that's given them one data point, and then they did it for every numeraire, and they got an upward sloping relationship. So I think this is kind of saying the same thing, but this is a very rough calculation. My rough calculations suggest that the gravity effects may be muted by trade weighting. Who cares? It's not, again, that the gravity effect in the equal weighted portfolios is not interesting. Anything that connects exchange rates to economic fundamentals is progress. Okay, but the economic importance of the equally weighted scheme seems less compelling to me than a weighting scheme that will govern how exchange rates are connected to the marginal utility of some representative agent. In an incomplete markets model in which shocks to a country's terms of trade are not shared internationally, what is a risky currency? It's one that co-varies with some sort of trade-weighted average of a country's terms of trade with all of its trading partners. Okay. I'll skip this about real exchange rates. The point here is going to kind of emphasize a little bit the importance of trade weighting. And just last thoughts. This paper and the authors and their co-authors and some other people's broad research agenda is certainly moving us forward. Here's a couple pictures from my international finance class to help me make this point. Here's kind of what we used when I first started working on this stuff, how we used to think about the carry trade. Okay, the top graph says unconditionally, uncovered interest rate parity seems like a pretty good model, right? Buy and hold, you don't really care if you put your money in yen or if you put your money in dollars because the interest rate differential gets offset by depreciation. Okay, so that's a graph of average depreciation against average interest rate spread. And if UIP holds, no currency risk, everything ought to be on the 45-degree line. And we used to think that that was pretty much what that graph was saying, and that the countries like Australia and New Zealand up there in the northwest were kind of, don't worry about those, small sample, okay. The carry trade, on the other hand, conditionally, we thought that's where all the action is. Now I think the consensus is changing, such that we got less confidence in these bilateral, at least bilateral carry trade things. And it seems like a lot of action is in the unconditional distribution. What's this paper contributing to this? Well, in the first place, previous work by these guys and their co-authors have been important for making that point. But now they're coming up with some fundamental economic variables to say why is it that some of what's going on in the unconditional distribution. Okay, 30 seconds, Ken. Honestly.
Jonathan's emailing me. I'm getting nervous.
FX disconnect, right? I'd hazard to guess if you look at all the headline financial variables out there. The exchange rate is the one where a journalist is most likely to just definitively tell you what happened and why between yesterday and today. But then you look at the data and there's nothing there. Okay? Oil, GDP growth, trade, gold, it's a cloud. Okay? These guys have found some variables that are connected more, and that's really important. It's not exactly the variables that it's going to help a journalist. You can only get so far writing about colonial linkages when talking about what happened to the dollar yesterday, but it's important. Best sentence in the paper, my last slide, connected to what I just said. Context, 2013. Bernanke signals the end of quantitative easing. Emerging market currencies tank, but a lot of other currencies are barely affected. Why? Is it differences in which policies? Is it differences in which economic conditions? The best sentence in the paper, our paper shows that the differential response...
They can read it. Thank you very much.